Ever wondered what a bridging loan is? Well, let's dive right in and put an end to that curiosity. A bridging loan, as the name suggests, is a financial tool designed to bridge a gap, specifically the gap between selling your current home and buying a new one. Picture this. You've found your dream house, but there's a catch. You still have your old home on the market. You need to sell it to finance the new purchase, but that takes time, and time is of the essence when your dream home is on the line. That's where a bridging loan comes to the rescue. It's a short-term loan that provides the funds you need for the new home, even before the old one sells. Think of it as a temporary financial bridge you can cross to reach your new abode. So, now that we know what a bridging loan is, let's delve into its pros and cons. What makes bridging loans attractive to some home buyers? Let's delve into the pros of bridging loans and find out. First off, bridging loans provide immediate access to funds. In the world of property transactions, timing is everything. It's not uncommon for the perfect home to come onto the market when you least expect it. But what if your current house hasn't sold yet? That's where a bridging loan steps in, providing the necessary funds right when you need them. It's like having a safety net, ensuring you don't miss out on your dream home because of financial constraints. Then there's the flexibility in repayment. Unlike traditional loans, bridging loans come with flexible repayment terms. Some lenders even offer rolled-up interest, where all the interest and the loan amount are repaid at the end of the term. This means you won't have to worry about monthly payments and can focus on selling your current property or securing long-term financing. Another advantage is the ability to purchase a new property before selling the current one. This eliminates the pressure to sell quickly, often at a lower price, just to secure the next property. With a bridging loan, you can take your time, secure the new property, and then focus on getting the best possible price for your current one. It's a win-win situation. Let's not forget about the potential for profit. If you're looking at a property that needs some renovation before it can shine, a bridging loan can be the perfect tool to finance the purchase and the renovation costs. Once the work is done, the property can be sold or refinanced at a higher value, turning a tidy profit. However, bridging loans aren't just for home buyers. Businesses also often use them for a variety of reasons, such as financing a business opportunity or covering short-term cash flow issues. The quick access to funds and flexible repayment options make bridging loans a versatile financial tool. It seems like bridging loans provide a convenient solution to timing issues in property transactions, doesn't it? But there's more to the story. Despite the advantages, bridging loans have some drawbacks. We've looked at the benefits, but it's equally important to consider the flip side of the coin. Firstly, let's talk about interest rates. Unlike traditional loans, bridging loans are short-term, typically less than a year. However, this short-term nature comes with a price: higher interest rates. It's not uncommon for the rates to be significantly above those of conventional loans. While the actual rate will depend on various factors like credit history, loan amount, and the overall market conditions, the fact remains that you'll be paying a premium for the convenience and flexibility of a bridging loan. But high interest rates are just one part of the picture. There's also the issue of additional costs. When you take out a bridging loan, you're not just borrowing money. You're entering into a complex financial transaction, and that comes with a host of additional fees. These can include administration fees, legal fees, valuation fees, and even exit fees when you repay the loan. These costs can add up quickly, and they can turn what seemed like a manageable loan into a significant financial burden. Now let's move on to another crucial aspect: the risk of not selling the old property in time. Bridging loans are, by definition, designed to bridge the gap between buying a new property and selling an old one. But what happens if you can't sell your old property as quickly as you'd hoped? Well, you're still on the hook for the loan, and you'll have to keep making those high-interest payments. This can be a particularly potent risk in uncertain real estate markets. If property prices fall, or if there's a slowdown in sales, it might take longer than expected to sell your old property. And the longer it takes, the more expensive your bridging loan becomes. Then there's the risk of a chain break. This is when a series of property sales, each one dependent on the previous one, falls apart. If you're relying on a bridging loan to buy a new property and your buyer pulls out at the last minute, you could find yourself in a difficult situation. You might have to find a new buyer quickly or risk defaulting on your bridging loan. So, there you have it. High interest rates, additional costs, and the risk of not selling your old property in time are just a few of the potential downsides of bridging loans. And while these loans can certainly provide a solution in certain situations, it's critical to consider these risks and weigh them against the potential benefits. Clearly, bridging loans carry a certain level of risk and can be expensive, yet they remain a viable option for some. Why might that be? Well, that's a question we'll tackle in the next scene. Stay tuned. So, when might a bridging loan be a good idea? You might be pondering this question, especially if you're in the throes of a property purchase. There are several scenarios in which a bridging loan might just be the perfect solution for you. Imagine this. You're on the market hunting for a new home, and you stumble upon your dream house. It's in the perfect location, has all the amenities you desire, and it's within your budget. The catch? You still haven't sold your current property. You're confident it will sell quickly, but you fear that waiting might mean losing your dream home to another buyer. In this situation, a bridging loan can be your knight in shining armor. It provides the necessary funds to secure your dream home while you await the sale of your current property. But that's not the only scenario. Perhaps you're a real estate investor and you've spotted a fantastic property at an auction. These deals often require quick cash, something a traditional mortgage can't provide due to the time-consuming approval process. A bridging loan can step in and offer the swift financial support you need to secure the deal. Or perhaps you're undertaking a major renovation project. You found a property at a knockdown price, but it needs a lot of work. A bridging loan can provide the funds to purchase the property and cover the renovation costs. Once the work is done and the property's value has increased, you can then secure a traditional mortgage and repay the bridging loan. In all these situations, a bridging loan can be a useful tool to bridge the gap between the need for immediate cash and the eventual influx of funds from a property sale or a long-term mortgage. However, like any financial decision, it's not to be taken lightly. In the right circumstances, a bridging loan can be a useful tool. However, it's crucial to carefully consider your options before taking one. With careful planning and consideration, a bridging loan can provide the financial flexibility you need in a fast-paced property market. Let's quickly recap what we've learned about bridging loans. We started by understanding that bridging loans, in essence, are short-term loans designed to bridge the gap between the purchase of a new property and the sale of an existing one. They serve as a temporary financial solution during times of transition, often used in real estate transactions. We then delved into the benefits of bridging loans. They offer a quick financial solution, enabling you to seize opportunities without having to wait for long-term financing. The speed at which they can be arranged is a significant advantage. Furthermore, they provide flexibility in repayment terms and conditions, which can be tailored to suit individual circumstances. Also, they can be used for a variety of purposes, not just property transactions, but also for business cash flow needs, renovation projects, and more. But as with all good things, there are drawbacks to consider. The interest rates for bridging loans can be higher than traditional loans due to their short-term nature and the risk involved. They also require a clear exit strategy, meaning you need to have a solid plan for how you'll repay the loan at the end of the term. Moreover, if the sale of the existing property does not go as planned, you could be left with a hefty debt to repay. Finally, we looked at when to consider a bridging loan. It could be a viable option if you're in a property chain and your sale falls through, or if you found your dream home and need to act fast. Businesses may also find them useful during periods of cash flow difficulties. However, it's crucial to understand that they are not a long-term solution and should be used strategically. Remember, financial decisions should never be taken lightly. Always weigh the pros and cons, and consider seeking advice from a financial advisor before making a decision.